The high volatility created by the mini-crisis in the banking sector, with Credit Suisse being its latest victim, tended to have a beneficial effect on gold's price. The collapse led investors to flee en masse towards the precious aiding its asset, at some point above the 2000 key psychological level. In this report, we aim to shed light on the catalyst driving the precious metals price, assess the future outlook, and conclude with a technical analysis. We make a start with the crash of Credit Suisse. The Swiss bank, despite getting 50 billion francs helping hand from the Swiss National Bank, was not able to survive. Over the weekend, the Swiss authorities persuaded UBS to pay 3.23 billion for the acquisition of Credit Suisse, following its spectacular drop of 26% within 5 days. It should be noted that the Swiss shareholders were favored over bondholders on unusual first, which rose substantial criticism for the actions of the Swiss government. Yet overall, the deal seemed to allow for relative easing of the market's worries. On the flip side, following the announcement of the deal, President of ECB Christine Lagarde said, "I welcome the swift action and decisions taken by the Swiss authorities. They are instrumental for restoring orderly market conditions and ensuring financial stability." Following the historic merger, a shocking joint statement was made by the Fed, BOC, BOE, BOEJ, SNB, and ECB, where it was announced that the swap lines between the central banks will allow the central banks of the Eurozone, Britain, Japan, and Canada to each day offer 7-day dollar banks loan to their banks. Overall, the common stance and decisiveness of the central banks not only allow another 2008 meltdown momentum to be created in the banking sector, tended to reassure the markets further. Yet there is still a fragile state where a number of banks are still wobbling, with an example being First Republic Bank in the US. Yet there are still many more with cumulative assets over $1 trillion. The wide uncertainty in the US banking sector and the criticism for the Fed's aggressive rate hiking path and lax supervision tended to alert the market's expectation for its interest rate decision tomorrow. After wild swings in the past week, the market's expectations seem to solidify at a 25 basis point rate hike, and it's characteristic that currently Fed fund futures imply a probability of almost 83% for such a scenario to materialize. Anything more could provide substantial support for the USD and weaken gold's price, while should the bank remain on hold, we may see the USD weakening substantially. Besides the interest rate decision as such, we also intend to focus on the forward guidance provided in the accompanying statement, and should the bank ease its so far aggressive hawkish stance, we may see the greenback slipping, thus benefiting gold's price. Also, we would like to see whether the bank will be issuing additional measures to stabilize the banking sector, like for example a possible guarantee for depositors. Furthermore, the new dot plot is to show us whether the Fed's policymakers expecting the terminal rate to be higher than in the last one. Should that be the case, that could be considered an additional bullish sign for the USD and vice versa for gold's price. Last but not least, we note the release of the Fed's projections for the course of the US economy, and should the bank's view be that a possible recession is to be avoided or even be a shallow one, we may see the USD rising and gold's price slipping. Thank you for watching.